Hi, I'm Rainey with Finance Strategists. In this lesson, we're going to cover
the cash flow statement, also called the statement of cash flows, is a financial statement showing how cash flows in and out of a company over a specific period of time. By looking at a company's cash flow statement, one can see whether the company has enough cash flowing in to fund its operations, pay its debts, and return money to shareholders via dividends or stock buybacks. The cash flow statement shows how cash moves in and out of a company's accounts via three main channels: operating, investing, and financing activities. Cash from operating activities, often termed operating cash flow, is the amount of cash left over after all the cash income and cash expenses for the core operations are received and paid for. Cash from investing activities lists cash used to buy and sell investments and long-term assets, such as capital expenditures. Cash from financing activities shows cash flows to and from owners, investors, and creditors like banks. It includes changes in debt and equity, as well as dividends and share buybacks. The sum of the cash flows from the three categories is termed net cash flow, often listed as increase or decrease in cash and equivalents. This number will be equal to the changes in cash and cash equivalents on the balance sheet for the same period. An important metric derived from the cash flow statement is free cash flow, which tells investors how much cash a company has left after expenses required to maintain and grow the business. This is calculated by subtracting capital expenditures from operating cash flow. A cash flow statement is one of three core financial statements released by publicly traded companies when they report earnings. The other two are the income statement and balance sheet. The income statement differs from the cash flow statement because cash and income are different. The income statement recognizes revenue and expenses when the product or service is provided, not necessarily when it is paid in cash. If a customer buys a product on credit, the amount is shown as revenue on the income statement, but it won't be included in the cash flows until the customer actually pays for the product. The balance sheet, by contrast, is a snapshot showing what a company owns as assets and owes as liabilities. The cash flow statement only shows actual cash flowing in and out of the company. This is crucial because cash is the lifeblood of a business. Without a steady stream of cash, companies can go out of business. Let's hear from you. Which is the most important of the three core financial statements? Cash flow statement, income statement, or the balance sheet? Leave a comment below.
For more information, visit www.financestrategists.com. Finance Strategists, strategies for your future.